All right, since I did my recent video on a backdoor Roth IRA contribution, I've gotten a lot of requests about the Pro-Rata Rule. This is a special rule that comes into effect if you have a mix of pre-tax and post-tax money in your traditional IRA when you convert it to a Roth IRA. So for the sake of this video, I'm going to assume that you already understand what a backdoor Roth IRA is and why you want to do it. If not, watch my other video. But I will go through a very brief reminder of what we're talking about. So a traditional IRA is an IRA typically with pre-tax money that has never yet been subjected to income tax, and it gets to grow tax-free and is only taxed as income when you take it out in retirement. You always hear it talked about as pre-tax money, but of course, when you get paid in your paycheck, you get taxed, and then you put that money in an IRA. So I want to represent that as first going into your IRA as non-taxable money. It's post-tax, it's been taxed in your paycheck. But then when you file for your taxes that year, you take a deduction for it. So that basically takes that bucket of money and reverts it to as if it had never been taxed. By taking a deduction for it, you're excluding it from your taxable income for that year. It's as if you've never been taxed on it. So this is a little nuance, but that's really how normal money in a traditional IRA is pre-tax money. And this is in contrast to a Roth IRA, which you just put your money into after it's been taxed. And so it's after-tax money. Your Roth money in your Roth IRA grows completely tax-free, and when you pull it out, you're never taxed again because it's already after tax. Now, the whole point of the backdoor Roth is to bypass these two policemen. As you may know, these guys are the income limits. You cannot contribute to a Roth IRA if you make over a certain amount of money. This police over here for the traditional IRA, he doesn't stop you from contributing to the traditional IRA, but he stops you from taking the deduction. You can still put your money into the IRA, but you can't take a deduction for it. And as you know, this is where the backdoor Roth comes in. You can put your money into your traditional IRA no matter how much money you make. You make $1 million a year, contribute to a traditional IRA, and you can convert it to a Roth IRA even if you make $1 million a year. There's only an income limit on contributing to a Roth IRA, not converting, and there's only an income limit in a traditional IRA on taking a deduction, not contributing. So this pathway allows you to get money into your Roth IRA and grow completely tax-free while bypassing both of the income limits, the backdoor Roth IRA. So backing up one step, let's talk a little bit about a standard Roth conversion. If you have normal pre-tax money in your traditional IRA and you convert it to a Roth IRA, you owe taxes in the year of the conversion. You're converting from orange, pre-tax money, to blue, post-tax money. When you do that, you owe taxes. Basically, the amount of money that you convert is added to your taxable income for the year. If you're in the process of doing the backdoor Roth, or for some other reason you have post-tax money in your traditional IRA and you convert it to a Roth IRA, there's no tax impact. No color change, no tax impact. So this might naturally lead to the question, what happens if you have both pre-tax and post-tax money in your traditional IRA? And the Pro-Rata Rule describes how you're taxed on a conversion. Unfortunately, you're not allowed to just convert the non-taxable money to your Roth IRA. So you can't just say, I want to do a backdoor Roth for the year, contribute $6,000 to my traditional IRA, don't take a deduction for it, and convert it to Roth completely tax-free. Instead, it's like the pre-tax money contaminates your post-tax money. Any conversion has to include proportional amounts of pre-tax and post-tax money. So let me show you that again. I want to make a conversion to my Roth IRA equal to the amount that I contributed in post-tax money, non-deductible money. But when you go to convert that money, it doesn't actually just pull from your post-tax money. The $6,000 that you convert pulls from your pre-tax money and your post-tax money in a proportion of how much of the two buckets were in your traditional IRA. So instead of a completely tax-free conversion, you owe taxes on some number equal to the amount of pre-tax money that ends up getting converted. So here's another way to think about it. It's as if the taxable money and the non-taxable money all get mixed up together, and then they calculate the proportion, the percentage that comes from each of those two buckets whenever you convert any amount. So this is very annoying. What can you do about it? Well, the obvious answer is when you want to go do your backdoor Roth conversion and you already have taxable money in here, let's say it's an amount, a reasonable amount like $10,000. Maybe you have it in here because you had a small 401k that you rolled into an IRA. Maybe you have it in here because earlier in your life you contributed to a traditional IRA normally and took the deduction for it. You can just convert the entire balance to a Roth IRA. You're going to owe taxes equal to the amount that was taxable, but now you've cleared out your traditional IRA, emptied it out, and you'll owe taxes, but for future years, you now have an empty traditional IRA, no pre-tax money contaminating your Roth IRA, opening up that pathway in future years. So you have the extra complexity this year, take the tax hit, and you've solved it for future years. Now, what if you had like $200,000 of pre-tax money in here? That might happen if you had a good 8-10 year career at one company, contributed heavily to your 401k, and when you left, rolled it all into a traditional IRA. You could have a huge chunk of money right here. The problem with this approach then of converting it all to your Roth IRA means you might be realizing $200,000 of income in a single year. That could bump you up into another tax bracket, so the marginal tax rate on that conversion could be much higher than it needs to be. So that leads to another option that if you're smart, you might be thinking of. What if I open a second IRA for the purposes of doing my backdoor Roth? I've got $200,000 in my traditional IRA, but I don't want to be subject to this pro-rata rule, so I'm going to open a separate IRA at another broker. Can I then make a conversion of just this money to my Roth IRA tax-free? And the answer, unfortunately, is no. The IRS doesn't care how many accounts, what brokers your IRA is in. The form on your tax return that calculates the pro-rata rule, it just takes into account all the balances of your IRAs. It's still all mixed together. This pre-tax money still contaminates the post-tax money here. If you try to convert this money, you will owe a proportional amount of taxes based on the proportion or the percentage of this amount versus this amount. But you can do something very similar. You can shelter your taxable money in a 401k, not in an IRA. So if your work 401k at your current job allows it, you can do what's called a roll-in or a reverse rollover. The terms are different in different companies. Take all that pre-tax money, put it into your work 401k. Now you've freed up your IRAs. You have no money in your IRAs, no pre-tax money. You can do a backdoor Roth contribution. Contribute your money, don't take a deduction for it, convert it to your Roth IRA entirely tax-free, because now the percentage of pre-tax money is zero. There's no pre-tax money in any IRA accounts. It's in a 401k account. So this is the best trick. If you have a large balance of money in a traditional IRA that's still pre-tax and you want to do the backdoor Roth, this is really your only option, is to have a work 401k that will allow you to roll in the money. Otherwise, probably just say forget about the backdoor Roth. So quickly, let's summarize the rules. First of all, the pro-rata rule takes all IRA accounts into consideration, even if they're at different brokers. How do you handle it? How do you overcome the pro-rata rule? One, you just suck it up and convert, pay the taxes in the year you convert your money. And this may make sense if the amount of pre-tax money in your IRAs is less than $50,000, or probably the best thing to do is say it's not enough to push you into another tax bracket. The other option is to shelter or shield that pre-tax money by rolling it out into a 401k. Another note that I haven't talked about yet is there's a separate calculation for each individual in a married filing jointly tax return. For the sake of IRAs and for the sake of the pro-rata rule, the IRS treats both individuals and a married couple separately. The IRAs are just in my name. If I have pre-tax money in my traditional IRA, I'm subject to the pro-rata rule. Whereas if my wife doesn't, she could do the backdoor Roth without having to worry about the pro-rata rule. And finally, one other nuance is that pro-rata calculations are performed based on the account values on December 31st of the tax year. So if you do your backdoor Roth conversion in April and you're attempting to calculate or predict the pro-rata rule, what percentage of that money, what proportion of that money is taxable, the answer you calculate at that time might be different than what the calculation ultimately ends up being, which is based on the value of the accounts December 31st. So that's a minor nuance, only helpful if you're trying to plan out your taxes perfectly in advance. Well, I really hope that was helpful. If you're interested in other funky tax stuff, early retirement stuff, and optimizing your personal finances, make sure you subscribe so you don't miss other videos about these topics.